Next, common probability distributions. The most basic is a discrete uniform distribution, and that is shown right here. So this is one discrete uniform distribution. So what does this mean? This means that for every value, the probability is equal. Cumulative means that you are simply adding up, and you need to be clear about all these answers. So in my regular lecture, I let you calculate this and I don't show you the numbers, but here, since we are going through the material very fast, just make sure that F1, which is the symbol for cumulative distribution up to 1, so that's 1/6. F4 means up to and including 4, that's 4/6. And here is something that people keep messing up on. F100 means that you've gone way beyond. So you've captured all this data and the probability is 1. The cumulative probability is 1. We are still on discrete distributions, and here we'll talk about the binomial random variable. This probability is the probability distribution of a binomial random variable for the probability of X successes in n trials, and it is calculated using this formula. P is the probability of success on each trial. So remember this formula. This should be done using the calculator. P is the probability of success. X is the number of successes, and the number of successes do not have to be continuous. They can be, if you have a scenario like this, 10 days and success is defined as the stock going up, the stock could go up on any 7 days. It could be the first 7, the last 7, the middle 7, or whatever. And if the probability of up move is 0.6, then P is 0.6. The other scenario is failure, which is 1 minus 0.6 probability, so it will be 0.4. And remember this formula. The expected value is n. So in our scenario, if n is 10 and probability is 0.6, so 10 into 0.6, so the expected value is 6, and the variance would be n, which is 10 into p, which is 0.6, into 1 minus p, which is 0.4. Now we come to continuous distributions. So this is a continuous uniform distribution between A and B. The total area here will be 1. So if you can say that a given variable can have any value between A and B, uniform would imply that the probability of being in any particular range, as long as this range is the same, is equal. So if you have A is equal to 10 and B is 20, then the probability of being between 10 and 11 is the same as the probability of being between 11 and 12, and each of those probabilities will be 1/10. This is the cumulative distribution function, where probability of being less than A is 0. From A to B we go up all the way to 1, and after that, if B is 20, what is F21? That is going to be 1. Alright, now we come to the most testable distribution, which is the normal distribution. Generally denoted by this, the mu is the mean, and sometimes you'll see S squared, sometimes sigma squared. That is giving you the standard deviation. Different normal distributions can have different means and different standard deviations. But what is it that is common across all normal distributions? What is common is that they always have a skewness of 0, which means they are symmetric. All will have a kurtosis of 3. And you actually need to remember the other facts shown over here. 68% of all your data is going to be plus or minus 1 standard deviation from the mean. 95 is going to be plus or minus 2 standard deviations, and approximately 99% is going to be plus or minus 3 standard deviations from the mean. The point that we'll cover on this slide is that you need to transform a normal distribution to what's called a standard normal distribution. With a standard normal distribution, the mean is 0 and the standard deviation is 1. So if you have any distribution and you want to transform it, what do? You take the x value and subtract the mean. So if you have a given distribution where mu is equal to 10 and sigma is 2, so this is for a regular normal distribution, what is the probability that the return will be less than 11%? So what do? You have to take this 11% number and convert that into a z value. And how do you do that? So the x is the 11 minus mu is 10, and then so you have 11 minus 10 divided by 2, so 1 over 2, which is 0.5. So this statement is the same thing as saying what is the probability that the return will be less than 0.5. So if this is 0 on the standard normal, you come to 0.5, and if you look at the data over here, the z value is 0.5, which means you have 0.6915. These are probabilities. So this entire area is a probability of 0.6915. Safety first rule. The context here is that if you have two portfolios A and B, one way of determining which is better or which is safer is to figure out the safety first rule, which is the return of the portfolio minus some threshold level or safety level divided by the risk of the portfolio. So you will come up with the safety first ratio for both, and then pick the one that has the higher safety first ratio, because the higher safety first ratio is giving you a higher return per unit of risk. All right, next, sampling and estimation. The idea behind a sample is straightforward. You have a population and you pull data from that population. If you have this population and you actually divide this into segments or strata, and then you pull a sample from each of these strata, then we call this stratified or stratified random sampling. Time series versus cross-sectional data. Time series is a sample of observations taken at specific and equally spaced points in time. Cross-sectional data is a sample of observations taken at the same point in time. Both time series and cross-sectional data, the random sample may be representative of the population we wish to study. Okay, some of you asked me about the central limit theorem, and this is very testable. I'll read this and give you a brief explanation, but then it is critical for you to practice lots of problems. Given a population described by any probability distribution having a mean mu and finite variance, the sampling distribution of the sample mean. So what does this mean? So you have a population, and let's say this population has a mean mu and some variance, and then you draw samples from this. The sampling distribution of the mean. So every time you draw a sample, the mean will be different. Okay, but can we say something about the distribution of the means, the sample means? We can, based on the central limit theorem. What does the central limit theorem say? That the sampling distribution of all these means, where the sample size is n, will be approximately normal. So we are saying that this distribution will be approximately normal. Now, without even knowing the central limit theorem, what do you think is the expected value of x bar of the sample mean? This is going to be mu. If you know that the population mean is mu, you don't know mu, but it's some number, then on average x bar is going to be equal to the population mean. That is intuitive. What about the distribution, the standard deviation of x bar? This is given by sigma, where this sigma is the standard deviation of the population divided by square root of n. And what about this sigma x bar? So this is also called the standard error. Sigma of x bar is the distribution of the sample means. So be clear about this. When we say sigma x bar, we are talking about the distribution of the sample means. When we just say sigma, then we are talking about the population. So the population has a certain variance and standard deviation, and the x bar has a certain standard deviation. Sometimes you might not know the variance of the population. So what is a proxy for the variance of the population? You pull out the sample, and the variance of the sample then is a proxy for the variance of the population. And here we are using the standard deviation. This segment deals with estimating the population mean with some degree of confidence. So let's say you have a population and you want to estimate the mean. So you draw a sample. What is your point estimate of the population mean? Your point estimate will be x bar, where you pull a sample and then you find the mean of the sample and you say this is my best estimate of mu. But are you 100% sure that x bar is equal to mu? Obviously not. Your estimate then actually needs to be x bar plus or minus something. What's that plus or minus something? That is given by this expression. Z alpha over 2 is calculated based on your degree of confidence. If you want to speak with 95% confidence, then the z value will be approximately 1.96. If you want to speak with 90% confidence, then the z value will be less. 99% confidence, the z value will be more than this. And then the second term is the standard error that we just talked about, which is the standard deviation of the population divided by square root of n, where n is the sample size. If you do not know the population standard deviation, then you use sample standard deviation. And another point is that when you do not know the variance, then instead of using the z-stat, you use the t-stat. For large sample sizes, the z and the t will give you roughly the same answer. In terms of the estimate, so x bar is an estimate. The process used to come up with the estimate is called the estimator. These are some properties. It should be unbiased, efficient, and consistent. Make sure you remember these three terms. It's very easy to be tested on them. All right, I have talked about reading the z table. Let's also talk about reading the t table. Let's say that you are given n equals 21. The first thing to recognize is that degrees of freedom equals n minus 1. So degrees of freedom will be 20. And then let's say that you are told that the probability in one tail is 0.025. Then what do you do? So if you are given one tail probabilities, this is 0.025. So notice that here the probabilities on a t table are given right here. On a z table, the probabilities were in the middle. So there's a difference between the z and the t table. You look up the degrees of freedom, and this is your answer. What if you were given the following? What if you were told that you are doing a two-tailed test, and on a two-tailed test the significance is 5%, and then the table you are given is this? So this gets some people confused. If you are doing a two-tailed test and the significance is 5%, that means the 5% is divided between the two tails. So how much will be in each tail then? 0.025 or 2.5% in each tail. So even though the significance is 5%, but given that it's two-tailed, you would still look over here, because this 0.025 corresponds to the probability in one tail. Alright, what should the size of the sample be? If you want a very tight confidence interval, then what you can do is increase the sample size. When you increase the sample size, what happens to standard error? It comes down because n becomes larger. Say you want to work with a significance level of 5% or confidence level of 95%, then the reliability factor is fixed. Okay, you can't do too much about your point estimate, that's simply the average of the sample. So the only thing that you have control over is the sample size. The larger the sample size, the tighter your interval. But does that mean you just keep increasing the sample size? There are some issues. The first question you ask is, how precise do I really need to be? The second is that if I take a very large sample, maybe I sample from more than one population, which is an issue. And often trying to get a sample that's too big will be costly. This is something I want you to read, and these things keep showing up. There are several challenges associated with sampling financial data. You might have a data mining bias, sample selection bias, look-ahead bias, time period bias. Make sure that even if you don't understand these in detail, you should at least remember the items shown on this slide. All right, hypothesis testing. Okay, now here is another item that lots of people have issues with, hypothesis testing, and then how to figure out whether we are doing a one-tail test or a two-tail test. So I'll give you some real simple scenarios that will help you understand the concept. You believe that the average return on all Asian stocks was not 0%. So you go to all Asian stocks and pull a sample, and the sample mean is 1%. Your sample size is 36. And the standard deviation of the sample is 4, and you want to use a 5% significance level. The moment you have a belief which says not equal to, then it means that you are doing a two-tailed test. If you have a belief that a number is greater than something or less than something, then you do one tail. So we've established that a not equal to implies two-tailed. So what is the hypothesis? You set it up this way. The hypothesis is that the mean is 0, because the null hypothesis is what you want to reject, and then the alternate is that mu is, the mean is not equal to 0. Alright, the rule for setting up the hypothesis is that the equal to sign must be in the null hypothesis. Then next thing is you need to come up with a test start. When you are doing a hypothesis test related to the mean of a population, then this is the formula, and this is a must-learn formula. It is one of the high probability items for your exam. So this is X bar. X bar is your sample mean. So you draw a sample and you take the mean of that sample, that's X bar. Minus mu naught is the hypothesized value, which is coming from here, so that's 0. And then Sx bar is the standard error. Okay, it is also the variance of the, or the standard deviation of the sample mean. And what's the formula for Sx bar? This formula is S over root n. In this case, we are given the S, which is standard deviation of the sample, and we are given n. So what is the standard error? It is this. S is equal to 4 divided by root n is root of 36, which is 6. So 4 over 6 is our standard error. What is X bar minus 0? That's 1. So 1 over 4 over 6. This gives us a test stat of 1.5. So you set your hypothesis, item 1, you come up with a test stat, item 2, then given a critical value, so this critical value comes based on the significance level. If you are doing a two-tailed test and the significance level is 5%, then the 5% is spread across the two tails. Let us say that based on this and this, the critical value is minus 1.96 and plus 1.96. All right, then how do you decide whether to reject the null hypothesis or not? If the critical value is in this range, then you do not reject the null hypothesis. Had the critical value been higher than 2 or less than -2, then you would reject the null hypothesis. Okay, next we look at a one-tail test. You believe that the average return in a given month was greater than 2%. So the moment you see this, you are doing a one-tail test, and if you believe that the return is greater than 2%, then make this greater than sign, and this is pointing to the tail that you are interested in. Okay, so that's how you remember which tail. So greater than means that you are interested in the right tail. Sample mean is 6%, and the rest of the data n is 36. Here now the standard error is given. So this is the hypothesis. Notice null is what you would like to reject, and it has the equal to sign. Alternate is that the mean is greater than 2. How do you come up with a test stat? It is the sample mean. So again, x bar minus the hypothesized over the standard error. X bar is 6. Hypothesized value is now 2. It's not 0. Divided by the standard error which is given. So here you don't need to do any further calculation. So you have 2.67. Can you reject the null hypothesis? Yes. You can, because now the test stat is greater than the critical value. Had the test stat been in this range, then you would not have rejected the null. But here you can reject the null hypothesis. Another important concept is the p-value, and people get confused by this. At the very least, you need to understand how to use this, whether or not you fully understand it at this stage, but you need to know how to make this work on the exam. So remember this definition. P-value is the smallest level of significance at which the null hypothesis can be rejected. It is analogous to the test stat. So there is a very straightforward relationship between the test stat and the p-value. A high test stat means low p-value. So if you come up with a test stat that is, let's say, way out on the right, the p-value is that little bit of probability that is still left. So high test stat means low p-value, and a low test stat would mean a high p-value. Now, can you use the p-value to accept or reject the null hypothesis? If you have a significance level of 5% and the p-value for a given scenario is 3%, if the p-value is less than the significance, then you reject the null. If the p-value is greater than the significance, then you fail to reject the null. So just remember what is stated on this slide, and there's a very high chance that if you do get a question, you will be able to answer it. Alright, type 1 and type 2 errors, you need to memorize these. So if this represents the true situation, let's say the true situation is that the null hypothesis is true. In other words, in reality, the null should not be rejected. And then based on your test, you do not reject the null. Is that correct? Yes. But is it possible that the null is actually true, but you incorrectly rejected it? That's possible. This is called a type 1 error. So just, say this loudly a few times to remember, because people have trouble remembering this. If H0 is actually true and you reject H0, that's type 1. So if H0 is true and you reject H0, that's type 1. What's the other situation? The other situation is that H0 is false. That means that you should reject, but you do not reject. That's a type 2 error. So say this a few times. Should reject, but do not reject. That's type 2. And when I say should reject, obviously we are talking about the null hypothesis. So in reality, the null hypothesis is false. You should be rejecting it, but you do not. That is a type 2 error. And the final point to remember from this slide is that the definition of the power of a test is that the power of a test is 1 minus the probability of a type 2 error. Okay, now we get into the domain where I'd say that strictly speaking this material is part of the course and you need to know at least the basics, but if you do not remember all the detailed formulas, you can still pass. There is tests concerning a single mean, which we've talked about, so this is very important and you must know. The key point here was to remember the test stat. What was the test stat? The sample mean minus the hypothesized value divided by the standard error, which is S over root n. So this is a must remember formula. You might also have to deal with a test concerning differences between means, and very occasionally this can show up on your exam. So this is the test stat for a situation where you are testing concerning the differences between means. So you have two populations, and if you have a situation where the two populations have the same variance, then you use this formula. There might be a situation where you have two populations A and B where the variance is different. Then there is a slightly more complicated version of this formula which I haven't even shown over here because, to be very honest, I have never learnt it and that's not hurt me. Okay, so if you want to learn it, you can. Strictly speaking, that's the diligent thing to do, but only do it once you have learned the important points and once you have practiced at least 3,000 questions. So once you've done that, then you can go learn the complicated formulas. You can also have tests concerning mean differences. So you have two populations, or actually the classic scenario that I use in my regular lecture is that you want to evaluate whether the return on Ford Motor Company and General Motors is different. So for every month or every period, you look at the difference between Ford return and GM return. So that then becomes what you are evaluating, the difference. So that's what we are referring to here, tests concerning mean differences. So you come up with the mean difference denoted by D bar, and then there is a standard deviation. This is the test stat. And then once you have the test stat, then the procedure is similar to what we've talked about. You have a test stat, you compare with critical value, and then based on that comparison, you decide whether or not to reject the null hypothesis. Tests concerning variance. Now, I would suggest that at the very least you just learn what's on this slide. When you have a variance, there are two scenarios. Either you have a test concerning the variance of a given population. For example, you have the variance of returns in the, let's say German stock market, and you believe that the the variance is more than 14%, just as an example. So there you just have one population, one variance, and the test that you will do is called a chi-squared test. And these are some points related to the chi-squared test. You will have a hypothesis, null hypothesis, alternate hypothesis. This is what the chi-squared test stat looks like, and you will compare this with a critical value to determine whether or not to accept the null, whether or not to reject the null hypothesis. And then the other type of test related to a variance is the F-test, where you are comparing variances. So remember this, chi-squared is where you just have one variance, and F-test is where you have two variances, and just try to remember all these facts. So read this slide a few times to memorize the facts. After that, all out practice. Now the last reading of QUANT. Okay, and this might look straightforward, but it took me a very long time to try and come up with the most important points. Yeah, so other than log normal and things like that, where I've deliberately left out things, going back to my picture, if this is the picture, so I've tried to cover everything that's over here. So my point is, if you understand this and then do a ton of practice, then you make this area solid and you sort of also pick up things over here. The final reading in quantitative methods is technical analysis, and this reading is a little different from all the other readings. You will notice that there are lots of graphs, lots of pictures. So my high level advice is that you understand the graphs. This reading doesn't have many examples, but all the practice problems at the end are very good. They are all in MCQ format. This is a relatively new reading. It was first introduced in 2011, unlike all the other quant readings which have been around for very long. So the quality of questions here is very high, and make sure you do all those questions at least 2 or 3 times. I obviously will not be able to go over every single graph, but in this particular segment I'll at least emphasize what it is that you need to know, and I've aligned this part of the presentation with the learning objectives. The first learning objective has to do with the principle and assumptions behind technical analysis. Technical analysis can be thought of as the study of collective investor psychology or sentiment. The premise is that human behavior is not always completely rational. Human beings are driven by emotion. And since market participants at the end of the day are humans, therefore it is only expected that emotion makes its way into financial markets. So to give you a very simple example, if everybody is upbeat about the market, there is a positive emotion, then it is conceivable that the market will have a positive momentum and prices become higher than what is rationally justified. So that's the fundamental premise. It is a form of security analysis. End of the day, you are buying stocks, let's say, to make a return. And if you do your technical analysis well, and technical analysis happens to work in your market, then this is a way of making money. We basically use technical analysis to decide when to buy and when to sell investments. The good thing about technical analysis is that it does not require detailed knowledge of the underlying instrument. So you are just looking at the volume numbers or the price numbers or some other metrics that are somehow derived based on price and volume to make a decision. You don't need to go study the economic drivers and the competitor behavior and the cash flow and all the other things that we discuss in the curriculum. As I mentioned before, the objective is to make a buy, sell or hold decision. The underlying logic behind technical analysis is that supply and demand determines price. So no matter what the underlying state of a company, if you believe that the demand for a given stock is going to be very high, then you buy. Because if the demand is going to be high, then what will happen to the price of the stock? It will go up. And then obviously changes in supply and demand can change prices. And a premise is that prices can be projected with charts and other technical tools. You need to know your charts, and I haven't listed the charts here, but you need to actually, either from my video lecture or from the curriculum, look at the pictures corresponding to each of these. So you need to know what is a line chart. Very simplistically, in the line chart, the x-axis is time, and then you are looking at stock prices plotted against time. What does this tell you? At the most basic level, it can tell you whether a stock is trending up or trending down. Then you have a bar chart which has more information. In addition to the trend, it will also show you for any given period, be it a day or be it a week, the opening price, the closing price, the high price and the low price. And then there are candlestick charts which are a little more elaborate. So in addition to all of the above, the way the candlestick chart is structured, it also shows you whether the market closed up, which means the closing price higher than opening price, or whether the market closed down. You need to understand the concept of trend, support, resistance and change in polarity. Market participants often display a herd mentality, which means that if there is a positive trend, then even if some fundamental factor changes, but because of that trend, the momentum, the herd mentality, the trend continues for a little bit of time, even beyond the point where new information has come in that suggests that stock price should come down. That's the premise behind technical analysis. And I'll just make a point here that later on in equity, we'll study the concept of efficient markets. If efficient markets hold, then technical analysis will not make you money. But by definition, somebody who's trying to make money based on technical analysis is assuming that his market or the market where he is operating is not efficient. Question?
It's not even weak form efficient.
Exactly. So if you can make money using technical analysis, then the market is not even weak form efficient. Alright, so you need to know these terms. Uptrend is where a market reaches higher highs. So what does that mean? If the market is going like this, to say that you have an uptrend, you look at all the highs, and if every time the high is higher than the previous high, then we say we have an uptrend. Downtrend means that the market has lower lows. So if the market is going like this, where the lows are lower than the previous low, then we say we have a downtrend. This would be the downtrend line which connects the lows, and this would be the uptrend line which connects the highs. Actually, I said that wrong. The trend line for the uptrend touches the lows, and the trend line for the downtrend touches the highs. And here again, I would emphasize that you need to go look at these charts in the curriculum. Support, resistance, and change in polarity. What does this mean? If we have a chart that looks roughly like this, when we say that the market or a given stock has reached a support level, this is a support level. That means that stock price is down, and at the support level, the selling will stop and buying will start. The thought here is that the market at a certain point believes that, okay, the stock has gone too low, so the selling will stop and buying will begin. This is called a resistance level, where the market believes that, okay, the stock price has reached a high, and then people stop buying and start selling. So that's the resistance line. So think of the resistance line as a resistance to an increase in stock price, and a support level as a support based, below which the price will not go. But this is not a hard rule. Sometimes the resistance and support changes. For example, the stock price here might break through the resistance level, and then the old resistance level might become the new support level, and then we have a higher resistance level. When this happens, this is called a change in polarity. Alright, next is chart patterns. So one thing is to understand charts, the candlestick chart and the bar chart and so on. Then after that, you also need to be able to look at the patterns and be able to predict what will happen. Patterns can be reversal patterns or continuation pattern. A reversal pattern is one which says that, okay, the trend is now going to reverse. A continuation pattern means that the trend will continue. So here are the various reversal patterns. These are continuation patterns, and in my regular lecture or from the curriculum, you need to look up these patterns and just need to recognize what they are. I have picked the one that I think is most likely to be tested, which is a head and shoulders pattern, which looks like this. So the name should give you a hint. Notice that you have a head and then you have two shoulders. This is a reversal pattern, which means that when you see this pattern, then initially if you had an uptrend, then after this pattern you can expect a downtrend. The next question then becomes, if there is an expected downtrend, where do you expect the price to end up? And the answer is, you do this formula. You look at the neckline, which is this, and then from the neckline you subtract this distance, the head. Let's say this distance is 5, and let's say the neckline is at 50. Then what you expect the target price to be is 50 minus 5, which is 45. Now this is again not a hard and fast rule. It's just based on observations in the past. When technical analysts have seen this sort of a pattern, they predict that the trend will reverse, and they predict that the price will end up being 45. 45 again being, start with the neckline as your base and then minus the distance from the head to the neck. Alright, so just to keep you with me, we talked about charts, then we talked about chart patterns. This item is technical indicators. Very broadly speaking, you can have indicators based on price, shown on the left side of the screen, and then indicators not based on price shown on the right. Not based on price, we are looking at sentiment indicators. So you do opinion polls. Are you bullish on the market, bearish on the market? Ask enough experts. If most people are bearish, then what will you expect the market to do? You will expect it to go up. There can be some calculated statistical indices for the sentiment. Another type is flow of funds indicators. Okay, some people here are talking about bearish and bullish, just to make sure you know this. Bullish means that you expect the market to go up. Bearish means that you expect the market to go down. All right. Fund of funds indicators, flow of funds indicators means that you are looking at where funds are going and using that to predict stock prices or whatever asset you are evaluating. And the logic is straightforward. The funds that are flowing in or out are giving you an indication for the supply and demand. And ultimately it is the supply and demand which will impact the prices in the market. Now I'm not going to go over each of these. At the most basic level, you need to recognize these sorts of indicators and you need to recognize the names. Obviously, I would want you to be more diligent here and then learn a couple of lines about each of these, which are given in my regular lecture. On the left-hand side, we have price-based indicators. So you have moving average lines, which basically take the average of the last 20 days or 30 days. So the point of using a moving average is that it smooths things out. So if you have stock movement like this, a moving average will be smoother and it will give you a better sense for what's going on. Then somebody named Bollinger created bands using the concept of moving averages, and essentially the bands are around the stock movement, and these bands allow you to determine where to buy, where to sell. Momentum indicators or momentum oscillators are also based on price, and these are the different kinds of momentum oscillators. I would encourage you to learn at least a line or two about each of these. Next point is cycles, and here again all I've done is, there are not that many learning objectives in this reading, so I've taken each learning objective and put a slide based on each one, so you need to know these. Technicians use various cycles to predict future movements in security prices. Even cycles, in fields such as astronomy and climate can influence the economy and hence capital markets. These are the commonly referenced cycles. Any of these might just show up on the exam as one possible cycle, so I'd say you learn the bullet point or two given with each type of cycle or pattern. Elliot wave theory. According to this theory, market moves in regular repeated waves or cycles, patterns of 5 waves as shown below. Each wave can be broken into smaller subwaves. So an important aspect here is that the pattern follow ratios which are based on the Fibonacci sequence. And if you want to be diligent, you can learn more about this. I think the probability of being tested on the details are low, but to be diligent, you should learn this material. And then the final slide here, intermarket analysis. This is based on the principle that all markets are interrelated and influenced each other. So you look for inflection point in one market as a sign for what will happen in another market. Use of relative strength analysis for different groups of securities to make asset allocation decisions. So you can do intermarket analysis where you look at stock related indices versus bond, the interaction of different sectors in the economy, and stock markets from different countries. All right, so that is it. I have actually created a formula sheet highlighting the most important formulas according to me from the various readings. So this is the formula for the interest rate. Learn it. I like you to use the calculator, but in scenarios where you are just given, say, a present value of 100 and interest rate of 10%, and you are asked for a future value, then you can simply use this formula. Or if you are given the future value, actually this next one is where you are asked to use continuous compounding. If you are given the future value and you want the present value, then the present value is simply the future value over 1 plus r to the power of n. All these can also be done using a calculator. The EAR is the effective annual rate. This is 1 plus a periodic rate. Let's say your period is a quarter. So you would take the quarterly rate raised to the power of m. What is m? It is the number of periods, and then minus 1 to get a rate. This is the effective rate where you have continuous compounding. So if your stated rate is 10%, then the effective rate is e to the power of 0.1, that's 10% in decimal, minus 1. And if you haven't done it, make sure you do this. Your effective rate when you do this will be a little more than 10%. There are formulas in the curriculum for annuities and annuity dues, present value of an annuity, future value of an annuity, but I've never learned those formulas and I don't expect you to either. I want you to use the calculator. That is much faster.
Yes, sir, like you given a formula sheet for QUANT, so will you give a formula sheet for all the other parts like fixed income?
Okay, so present value of a perpetuity is equal to A over R. So if you have a cash flow forever, then to calculate the present value, you take the cash flow divided by the discount rate in decimal. Okay, discounted cash flow applications. This is the NPV formula, simply the present value of all the cash flows. And this includes the first cash flow, which is typically a negative. The IRR is the rate which makes NPV 0. And then you need to remember all these formulas. Now here I have highlighted a point that keeps confusing students. Notice this formula, effective annual yield. Is this the same as what we saw on the previous slide, the effective annual rate? Some people think they are different, but actually it is the same thing. So if you think about it, let's say your stated annual rate is 12% and you are doing quarterly compounding. Then what is your quarterly rate? It is 3%. If you think about it, that 3% is your holding period yield for a 3-month period. So the holding period yield and the periodic interest rate are analogous. All right. And then here you have to the power of m. What is m? M is the number of quarters. So in this example, m would be 4, which is analogous to 365 over t, because if you literally have 90 days in a quarter, then this would become roughly 4, just slightly more precise. So these two are actually the same thing for all practical purposes. Alright, then this is the geometric mean formula that you need to know. The harmonic mean, number of terms over the sum of the reciprocals. The weighted mean is straightforward. We've talked about the location of observations at the y-th percentile. I think everything else here is self-evident. Notice actually that there are not that many formulas to remember. And the way I want you to work on this is, if you have the intuition for these formulas, then there is nothing that is too difficult. So don't be intimidated. And this is a good point about not talking about being intimidated. Even with probability formulas, there are not that many. Right? So just remember them. And as I said before, when you do a probability question, just put these down and then you should be fine. Alright, and this is the last slide. So this is your binomial, the expected value. This is the safety first ratio, the standard error of the sample mean. So this should strictly speaking be the standard deviation of x bar, which is the sample mean, is equal to the variance of the population divided by square root of the sample size. This is the confidence interval, and this is the formula for the test statistic when you are doing tests related to the mean of a population. So that is it for this segment. As always, do a ton of practice. In the next segment, I am going to go over questions that have been submitted.